Hello, everyone. This is the first panel discussion of the day, and it's already evening. We've had so many fireside chats. Now, this is the first panel discussion. Welcome, and everyone wants to listen to you all because of the scenario right now. People want you to simplify things for them. What is all this reset all about, Lavish? I'll begin with you. What do you think of, what India should do? How should India reset itself in this volatile global scenario?
Thank you. You did give me the. So it's also obvious that it's not just about the geopolitics or geoeconomics, but it's also about technology. It's about the environment. And it's about how global cooperative solutions are emerging. And cooperative solutions need not just be multilateral ones, there are bilaterals, trilaterals, and so on. And almost none of this is predictable. In such a situation, I think it's but obvious that people will say that we must be opportunistic. People will say that we need to be transactional. But we need to think through, what does that really mean? The most important thing is that you have to be internally strong. Now, what does that mean? The way I see it, and you're welcome to have a different view, internal strength essentially means, obviously you need to have your internal reforms and so on, but you also need a very strong capacity within the government, within the state. And I'll give you some examples. FTAs, just conversation that was just happening a few minutes back with some of my colleagues outside. We will need to have parallel FTAs across with many countries, perhaps groups of countries. But we will need huge internal strength to be able to negotiate the right kind of FTAs for us. And if you're going to negotiate in parallel with 5 or 10 or 15 countries, would you have that internal capacity? That's just one example. Transactions, you're going to have multiple kinds of transactions. You're going to be very fluid. You're going to have a lot of events where transactions or promises will not be kept. And is your judicial system able to deal with such ups and downs? And the answer is obviously not. You definitely need to deal with internally a judiciary and the judicial delays especially. Not so much the judiciary, but so much the judicial delays. There are a million and one things. But what I'm broadly saying is that, yes, it's fine to say that India is at an amazing situation, which it is. It's been an unparalleled situation. Every single country would want to engage with us, and we are really fortunate, and some good actions done by us. But at the same time, the next step will require us to become internally strong. And I think that's what the conversations need to be about going forward.
Thank you, Lavish. You explained it well, and I hope the second question will be tougher for you. Mr. Tushar Vikram, I will call you Tushar only. Yeah? That's always easier, calling by the first name. You are coming from the UAE world, and you're very familiar with that scenario. There have been, trade pacts with that geography. So, what do you think UAE how can it play a role in the India reset narrative?
Well. My question is even easier, so from that perspective, but yeah, so I would say, the Comprehensive Economic Partnership Treaty, which was signed between India and UAE, was in 2022, so about 2 years ago. And apart from the treaty, I think the cultural linkages and the Indian diaspora linkages, I think linkages from an industry level and also at the political level are the best right now, which led to this treaty and increased business cooperation and partnership. And in this world where, there are multitudes of partnership, I think this would be a very important partnership for India because of various reasons, because UAE is our third largest trade partner already. And with this kind of trade agreement, it is only going to grow larger and become more important. So UAE is a large market for India exports, as well as for Indian people, as we know it. Secondly, India is an important kind of strategically important for UAE because UAE is right now looking at things like food security, how to get better healthcare, better pharmaceuticals in the country, which is very core to India. So apart from oil and precious metal and people, I think on the pharmaceutical side, on the healthcare side, and there is active dialogue and this thing. A lot of UAE companies are coming to India. They working in joint venture to set up food parks and other collaborations which is happening. And secondly, I think as we all know, UAE has a lot of wealth and sovereign wealth funds and family offices. So they are also becoming big investors, both on debt and equity in our capital market.
So especially in this post-Trump era, how do you think this UAE pact will, have an impact on Indian economy?
It would have a very positive impact. Like I was saying, that the trade in both the countries is actively working together. We are working as a bank to enable UPI transactions for NRIs. This is kind of a first. So there are lots of areas apart from trade and partnership and financing which the two economies are working. And this will also help, not that we are dependent on the US or any other part so heavily, but it will help sort of diversify our access. And UAE is also partly a gateway to Africa. So a lot of companies are African companies or this thing, even Indian companies who have offices in Africa. UAE is the headquarters, so it also provides a gateway to Africa. So it has a sizable wealth, it has a sizable market, as well as a gateway to Africa. So it has a potential to become a very important pivot for India going forward.
I'll go over to DK Joshi. DK, as everyone knows him by, there's hardly any financial journalist who doesn't know him. So my question to you is, what do you think will be the trigger for growth in India?
In the near term or in the?
Both.
Okay, I think we got positive surprises post-pandemic. Every print of GDP was revised upwards, I think. So analysts were also surprised when you got 8.2% in 23-24. And now in 24-25, this is the first time I think you've got the forecast lower than the general expectation. So economy is in a way returning to its trend path of rate of growth, I think, which we believe is around 6.5% or so. Pre-pandemic growth was also around 6.6%. So, and this was engineered partly by somewhat tighter monetary policy and also fiscal impulse which was being withdrawn. So I think so this is a standard trajectory of growth. Now, what happens in the coming fiscal year? We expect around 6.5% GDP growth, and this is, I think there are some assumptions. These days, I think you need a lot of assumptions. I think it's not just simple assumptions like rainfall. And I think we start the year with a normal rainfall projection. But as I was coming here, I read that there is a statement from the weather department that March may turn out to be the hottest year in recorded history. So you have your wheat crop coming. So I think, so there are various things that you need to figure in. Apart from that, monetary policy is turning a little more supportive, and the risk weights, etc., are being brought down. So that is also going to help. And I think to some extent, or maybe for some to a large extent, food inflation coming down would mean that they have more discretionary spending at their disposal. So all this combined will bring you closer to 6.5%. So this is the short period. Now, if you want to look at, let's say, next 7, 8, 10 years, we have a forecast until the end of 2030-31, which is 6.7% GDP growth. And we look at it in terms of what contribution capital will make, what contribution labor will make, and what contribution productivity will make. Productivity is a kind of a magic. I mean, so if with the same amount of capital and same amount of labor you produce more, I think you get tremendous benefits in terms of growth. So our assessment is that capital will contribute the most, and until now, government capex in infrastructure has contributed, which has multiplier effects. Also, I think we have seen the household being very active in buying, purchasing houses, etc. That is also a part of capital formation. That's also very active. The only part which is lagging behind and which in a way has the strongest capability to spend. I think the financial flexibility of the corporate sector is today highest in the last 10 years, yet they are not investing. So I think how do you bring them back? And the budget in a way looks at deregulation, decriminalization, etc. as means of bringing them back into the fold. So capital is this what is going to help. I think labor it doesn't contribute too much to growth. The labor is not able to participate. I think the remedies are pretty well known. I think it's an issue of implementing them. It's basically education and skilling, I think, which is going to be important. I think I'm coming to the third part, which I think is the most critical, and I'll close with that, the productivity. Now, productivity I see it as being driven by three factors. One is your infrastructure build-up. Second is your digital infrastructure. And third is reforms. Now, which Lavish also talked about, I think, very briefly. Here, I think the critical point is that physical infrastructure, we are seeing the benefits of that play out in terms of improved connectivity. Although the last mile connectivity is still an issue, but I think the overall connectivity within the country has improved. The turnaround time at ports, etc., are coming down. So the logistics cost is reducing. This is actually, we are still lagging. So this is one area where if you push more, I think you will achieve higher growth, because you now want to backward integrate your electronics, etc., for which without logistics, it's going to be very difficult. Digital is what leapfrogged after the pandemic. And here I think the benefits are visible not only in terms of payment systems, etc. I think the digital infrastructure or digital system generates a lot of information, and that allows you to take better decisions, which is like you can disperse a loan very quickly in half a day instead of maybe taking a week. So I think digital has many benefits that come with it, and I think we haven't exploited many of them. Reforms is the third and the last part and the most important part. Unlike the first two, it doesn't require money. I think so. It requires a different kind of capital to be able to pull the states and I think build a consensus around that to push growth up. Now, if I look at the post-pandemic recovery, the fastest growing element is the digital. Second is the physical infrastructure, and the last is the reforms. And I think in this global environment where I think the external triggers to growth will be minimal, I think we have levers that we can push domestically. And I think one of the levers, I think main levers is reforms, I think which we saw in policy discussion. But I think if you push that up, I think it will complement your digital and physical infrastructure, and it will allow you to combine capital and labor more efficiently and produce higher growth. And the last point is that I think the way I look at India versus advanced countries or rest of the world is, if you plot GDP data for last 40 years for, let's say, India and advanced countries, you'll see two things. One is that the economic cycles have got synchronized because we have connected more, we trade more, and we also, I think the financial linkages are very strong. So growth cycles, the synchronicity is almost remarkable, I mean, for the last 20 years. But the trend rate of growth is very different. I think India has been trending up in the last 40 years, and the advanced countries have been trending down. So there is some decoupling there, and that is because we have been able to pull some domestic levers to push our potential rate of growth up. So this 6.7% is based on normal assumptions, but if you pull the lever more, you can achieve higher rate of growth. Thank you.
Thank you. I'll go to Sandeep next. I was speaking to Sandeep before this session, and he told me he is not an economist, he is a practitioner. So let's hear it from the practitioner. You are in the mutual fund business. Mutual fund sahi hai. Is that something that we should be talking about right now?
Thanks a lot. I think broadly, first let me say it's a very interesting time in India, where I think we all grew up with that mutual funds are subject to market risk, to a mindset of mutual funds sahi hai. But when we are talking about the economic reset of India, I think it's very interesting to see how the trends are changing, how the mutual fund industry is able to convert a lot of household savings into capital market. Let me give you some data points that will give you an indication. It took India 50 years to to get first 10 lakh crores in the mutual fund industry. It took the next 10 lakhs came in 5 years, the next 10 lakhs came in 3 years, the next came in 2 years, the next came in 6 months. But I think what is more important is, I think how the investors have started coming from small cities and towns. So, and why I say this, I think it's mutual fund industry is not just about creating wealth for investors. I think it plays a very, very important role in the economic growth of the country. And to give some data, at this point of time, I think we are seeing a lot of it's fashionable to talk about FIs are leaving India, a lot of money has left India. But the reality is, first, I do not believe that I think anybody is leaving India. FIs will keep taking tactical calls. And I think definitely if we are talked of the 6.7% growth we are talking, nobody can stay out of India. I mean, everybody will have to be invested in India. But more important thing is, all this while, I think the last quarter, we saw almost $12 billion of FI money go out. But the bigger counterforce to that is the mutual fund, the SIP money that is coming in. And I want to give again, from a data point of view, at this point of time, we are doing roughly about $3 billion of SIP per month. And let's convert this into 140 crore people. We are investing about 28,000 crores, 200 rupees per month per Indian is investing. Now just think of if you have to achieve the dream of the Prime Minister Viksit Bharat, what this industry can do. We are at a stage where I think if every Indian today is investing 200 rupees per month, if we were to say the economy size has to double and we become the third largest economy within this decade, the per capita income goes up, this 200 will become 400. So technically speaking, we are looking at a point where $100 billion of money every year will come only from domestic savings. And how the trend is changing, just 10 years back, only 0.8% of household savings were coming in the mutual fund industry. Today it's gone to 6%. Last year, there were more than 300 IPOs. And out of 290 IPOs, roughly 290 plus minus, here, there, mutual fund industry played a very big role. So it's a very important thing, mutual fund industry is playing a role. But I want to also come to this point that it's not only the mutual fund industry, but somehow I think the attractiveness for India continues to grow. I represent a Japanese company. I think we see a lot of interest coming from Japanese investors into India, and it's not only into the listed equities. So I think India continues to attract a lot of foreign capital, and whatever has happened in the last 6 months, the market's not doing well, sell-off by FIs, should not be seen in a negative way. FIs will continue to do tactical allocations, but mutual fund industry is going to be a strong counterbalance to that. And I think we are at a great point, inflection point in India. There are always two capitals, you need financial capital and human capital. I think I don't have to talk about human capital, the demographics that we are having, average age of 29. But I think the financial capital part, I think we are at a point for the first time, India will not have any constraints of financial capital, whether it's domestic or foreign.
Thank you. It's interesting that we are having this panel discussion today because tomorrow we are going to get the numbers for Q3, the GDP numbers. So Lavish, what is your take? What do you think the number is going to be?
I'm going to change the story here. Okay, let's just make it interesting. So I'm not really interested whether it is 6.5 or 6.7. To me, that is glass half full. I'm not at all interested in it. I have one number in mind, which is in 2047, I am a developed country, and for that, I need 8.5%. Okay, so my glass half full is not important to me, it is the glass full. Okay, now what is it exactly that we need to do from there? I mean, I can't identify all the points like DK did, and they were absolutely right there. But I think we do need to look at the bigger picture here. What is it that is preventing Indian industry with an incredibly stable government? We haven't had such a stable government ever. Okay, with an incredibly stable economy which has grown for decades, like at rates which had not happened anywhere in the world. All that can go for India is going for it, and yet our own internal investor is not investing. Why should someone with FDI come to India? And if the investor is not going to invest, why should the household not save more? I mean, why should the household save more? Right? I think these are the real questions and we need to address it. I do not think we are getting enough cues from the industrial sector, or what exactly is the problem. You're not going to get it better than this. then if we are not going to get it better than this, then why will we reach 8% plus growth? So to me, that is the question that we need to address. I think that is really what lies at the bottom of the problem. Yes, for instance, I'll give you an example. I've talked about the judicial delays. I think we need to address this. It's a serious problem. Okay? You cannot contract if you can't go through the judicial system. That's one. You have a tax code which is going to be reformed. We need to look into it and identify, is that the solution, or do we need an even bigger solution than that, right? We really need to identify the real things out here. Yes, things may improve a bit, things may go down 0.5 percentage point or 1/4 percentage point. It's okay. In the long term, these ups and downs will keep on happening. So I think I would just look at the big picture elements here. Middle East, amazing opportunity for India. It's going to be the largest center, financial center after London. It's the way it is evolving. And yes, it's great that we are having a strong play there. Right? I don't think there will be any other place across the globe which is going to be as much. So I think we need to identify the really 3 or 4 critical elements, but we really need to identify them hard. So that's one. The second thing, and I think I'll again go back to the point that I had made. The government needs to invest in itself. And I mean this, that you need a technocracy which is stronger. The way technologies are changing, of course the governments will need to invest in themselves. And I'm not just talking about the union government. You have state governments, you have urban local bodies. These entities need to invest. You cannot reach developed country status without that happening. Okay? Well, of course, I could go on and on. I don't know how many minutes you'll give to me. But I'll say, in the end, one last boring thing, which we all know has to be done, but is never done. But I'll try and say it in another way. Okay. Primary school education. The person who's going to be at 30 years of age, roughly in 2047, is your main worker, is about to enter primary school right now. Okay. At least half of the graduates of primary school cannot read or write. So 2047 dream is gone if you can't get your primary schools right now. You cannot wait for 1 year, 2 years, 3 years. You have to do it now, because that child is going to be the worker in 2047. So, and that's not just, by the way, the union government, because it has to be the state governments that have to do it. It has to be urban local bodies that have to invest in education. So I think these are the real issues that we really need to get down to, rather than bothering about, I'm so sorry, the quarterly growth, because quarterly growth will happen, there'll be some up and some down. Thank you.
Thank you, Lavish. I'll go to Tushar. Tushar, like Lavish pointed out, we have to look at the big picture, and 2047 dream is already drawn. That's a very, very important thing to note. Do you agree 2047 dream is drawn? So what should we do about it? And since you've come from the investing fraternity, you've been, with Citibank earlier, you've been an investment banker. So what is the investment scene like really, and why are investors not investing?
I think 2047, like you said, is cast in stone. That target has been set. But it depends on which part of investment which you're looking at, because if we saw sectors like infrastructure, that development, the government's expenditure on infrastructure has been very high. It was almost 18-19% of the budget, which was historic high. We were constructing 30 kilometers of a road every day, which is really unheard of and a kind of a Guinness Book of World Records. And if you look at the industries on the back of that government spend, whether it was steel, cement, or the other feeder industries, they have been expanding. So it depends on the end user. The consumer durable investment consumption is less, so that industry is not expanding, but the support industry for real estate, infrastructure is investing. And you hear every day the big cement companies announcing doubling capacity, steel companies doubling capacity. So that segment is doing well. I think what is required for us to continue this growth is the private sector capex to be all pervasive, not limited to a few sectors. And we are seeing foreign capital apart from the mutual fund industry investing in the country, but obviously they're looking at the valuation. So they are value buyers. So we continue to see where they are. And we have a very robust private equity market in the country. So apart from the public capital, I think the private capital is also playing a very big role. And they have very deep pockets and they continue to invest. And these are the unlisted companies, the mid-market companies or the SMEs, which are the future growth companies which they're investing. So what I would say is investments is happening in pockets, growth is happening in pockets, but the overall story to pick up, all sectors need to go and be persuasive. Hopefully some of the things like the tax reforms and others with the elections behind us, and depending on how the agriculture monsoon performs, things should come back. But there is a degree of premiumization happening in the consumer durable sectors. That's why you see more of premium cars being sold than the entry cars. So again, the expenditure is happening on the premium side, so is the capex. But to have a uniform kind of growth, I think all cylinders need to fire. And for that sector, especially the consumer durable sector, which is now investing, should also start spending.
Thanks, DK. I'll just move on from this subject, inflation. Is that something that we need to worry about even now, or is the war on inflation kind of behind us?
I don't think the war is behind us very clearly. See, if you look at how the inflation has moved in the last 2-3 years, it's been food, which is, we are in a way helpless. I mean, you can't bring food inflation down very quickly. I mean, we've seen that with this kind of climate shifts that are taking place, it will take time before we adapt to the shifting climate. So the core inflation, we were blessed with a very benign number. I think the non-food inflation in 24-25 will be around 3.1, 3.2%. It was just the food. Now what's happening is that core is beginning to move up slowly, and food inflation is beginning to move down. So I think whether you have won the battle on inflation or not depends on whether you can predict the food inflation correctly. So I would say that we have to be very cautious in this environment because the base effect has been very high for food. Vegetable inflation was 26% in 24-25, around that. So that base effect will bring down the inflation print. The prices may not come down that much, but the inflation print will come down. But that itself is not a big comfort factor because we cannot predict the climate. As I was telling, the March itself is an issue. So there are some, when we look at, I mean, our forecast is 4.4%. I mean, I deal with numbers, so I have to give some numbers. My clients won't allow me to get away without the numbers. So, and that is premised on some upward movement of core inflation, and some companies are already passing on the costs, I think, because I think they have to pass it on because inputs were expensive in those segments. So 4.4% inflation is, you can say, is moving towards the target of the central bank. Now, central bank has 4% inflation as a durable target, I mean, as a target which they want to achieve on a durable basis, which means it should not be a flash in the pan. And to do that, I think you have to control food inflation. I think every episode where India's inflation was below 4% on a durable basis also saw food inflation very benign. It hasn't happened so far. So I think I think food is the big joker in the pack according to me. And we will, I think 24-25 or 25-26 promises to be benign in terms of oil prices because I think Mr. Trump is trying to pump oil further. And also because China will face pressure, so it's going to bring down commodity prices as well. We are already seeing the flat steel prices were down 10% in 24-25 because of excess capacity coming out of China. So I think it's a mix of things that will play out for inflation, but I would hold my horses, I think, in calling it a victory. If with your permission, if I may just add a bit to the private and corporate investment part, because
Sure.
I think we are also struggling with trying to find out what's going on. So 3 things that come to our mind. One is the unevenness of demand, which was also being pointed out. That doesn't give right signals to the person who's going to invest. And there has been a lot of volatility in the demand segment, I think, up and down. You saw when you were growing at 8%, 8.2%, private consumption, which is 57% of GDP, was growing at 4%. And then when your growth is slipping down, your private consumption growth has gone up. So I think the unevenness in consumption demand is one factor. Second, I think, is the unintended, or rather the collateral damage that comes from tariff wars. So if China has excess capacity, it's going to suffer deflation, and that is going to flood the markets in Asia and also in India. We have a huge trade deficit with China, and that is, for a company that uses steel as a product, it's very good news. But for a company which manufactures steel, it may not be good news. For manufacturer of some other things, it may not be good news. So I think that's why we keep putting safeguard duties. So I think this, the risk of what will happen when the Chinese capacity floods the markets, because if US closes doors for it, that is also playing in the mind of many investors. And the third reason is that because of the uncertainty element, corporate sector is awaiting higher utilization of capacity now. They want to see, it's around 75 or so in manufacturing, but they want much higher now. I think so the comfort factor the threshold has gone up, I mean, for some reason. I think these are the proximate reasons that we see impacting private corporate investment. Their financial flexibility is superb right now. I think the ratings upgrades are far more than the downgrades. So they are in a very good condition to invest.
Thanks, Sandeep. Related to these core economic metrics like growth and inflation and everything, how do you describe the consumption trend that you are watching as a practitioner?
Oh, I think I'll just touch something on primary education and inflation. I think first, I think it's very heartening to see the financial awareness in education is getting better in smaller cities and towns. And why I say this today, because I think it's only 3% of the population, 3-4% of the population of India is covered by the organized the pension reforms and others. So effectively, we are seeing one big change, that people are understanding the impact of inflation, and that is the one big reason you have seen a big change in how people are investing. And the reason why I say this is a very, very critical thing, because what we saw in past was, I think it's not just about inflation, how inflation makes you poorer day by day. And that awareness, as we are going to small cities, towns, it was never there. People never understood that inflation actually eats away their wealth. So that change has started, may not be happening at the pace at which we would desire, but I think I'll give credit to the industry and the regulatory bodies. A lot of financial awareness and education is showing results. So that is point number one. I think as far as the consumption is concerned, clearly when we look at some of the listed companies, I think that's how we see it. Clearly it's a mixed bag. I think it is not, it is not the way we would have expected. I think clearly when you look at some of the FMCG companies, some of the other companies, the story in the big cities is very different from stories in the small cities and towns. And also when you look at also some of the stress that is being felt by MFIs is maybe, I think again like I said, maybe a function of there is something happening in smaller cities and towns. I think the cash in hand, something is not going the way we expected. So I think from our perspective, clearly consumption as what we would have expected, it's not gone that way. But clearly, let's look at the positive, this budget. What the government has done for the first time, till now it was all the incentives earlier were given on the supply side. For the first time, by leaving more cash in hand, I think what we are also going to be pushing investors, pushing consumers to go and consume. So I think clearly we are not as bearish, but things could have been better.
I'll ask all of you about one thing that every speaker spoke about all through the day today, that is deregulation. There is a lot of emphasis, at least, in writing and speaking from the government side, that, there should be deregulation. So Lavish, what do you think? Is it likely to happen? And what is it that we are going to achieve from there?
So you're absolutely right. I mean, I'm hearing a lot of conversations, actually been a part of some in the government on deregulation. But I don't think deregulation can happen without industry being honest about the kind of challenges that they are facing. In most of these conversations, I find there are some industry representatives and they tend to be quiet. So if you're not going to be sharing the classes of problems that you have to to normally deal with, it's going to be difficult to identify the key issues related to it. I mean, one of my pet peeves is obviously judicial delays, and I've already talked about it. I think that's a huge one. It's not classically a regulatory problem, but it is a problem. I mean, it's one huge issue. But then you talk about every single regulatory institution, there are two classes of issues that it is facing. One, most regulatory entities in India are actually under-resourced. They don't have adequate technologies, they don't have adequate people, they really don't have the kind of understanding that is required for you to for you to go into the next 10 or 20 years. So I think we need to invest in our regulatory entities for us to be able to regulate better. I think that's something which in this conversation needs to have. The second thing is regulators in India rarely talk to each other. Okay. Now in the economy that we are looking at of the future, you will need regulators to talk to each other. Even if you not coordinate, at least transfer information from one entity to another within the regulatory setups, right? So you need to have all kinds of operational issues which will need to precede before you can actually have proper regulatory reform or rather deregulation, as you're saying. I think there's one more thing I'd like to add to this, and I think it needs to be understood very well of how this whole thing happens. Most regulatory entities in India are manned by people who were in the government, right? And it is rightly so. And we have to understand what the problem is. So suppose I am going to set up a regulatory institution in whichever sector, okay? Who will I bring? Someone who has some understanding of that particular issue. Let's say I'm minister of whatever, right? Who will I go to? Some retired officer who I know has dealt with that issue. So there is an informational issue there, I will only go to them. Okay. Now in India, strangely, this is not true in other countries, we will only go to people who have grown up in the Indian system. Okay. We rarely bring people from outside. Definitely we don't bring international people into our regulatory setups, right? We don't even bring them into our universities, forget that, right? But we don't do that. So automatically, by default, you're only getting people from the bureaucracy in a regulatory setup. It'll be very difficult to have real deregulation as long as that happens. You can't go to industry because no one trusts industry in the government. Never has. Okay, hopefully it will change in the future. So you can't do that. Where will you draw people from? So I think that is something, that's a real issue that needs to be addressed. It's a problem that is not so, it's not so halka that you can say, okay, fine, I'll solve it by doing A, B, and C. It requires a lot of deep introspection.
Tushar, regulators don't talk to each other. We only get government people as regulators. What is the global experience in the regulatory sphere?
So what I would say is that coming from the banking industry, our principal regulator is the Reserve Bank of India. And not speaking of specifically, but to point, they got a person like Raghuram Rajan, who had international experience and brought a breath of fresh air from that perspective. So what I would say is, while regulators don't say it, but from a financial sector perspective, they're very connected. They talk to each other a lot, they exchange a lot of ideas, and being worked in 3-4 multinational organizations dealing with regulators in the US, in Europe, now Middle East, I would say that our regulator, the amount of communication which we can do and clarify probably is more open than the Fed from that perspective. That's been my personal experience. I could be wrong also. Now, having said that, our problem is that we have multitude of regulators and we have a federal structure, so we don't not only have central regulators, but we have state regulators also. So I'll give you an example of one of the countries which is becoming a manufacturing hub. If you want to open a factory, they give you a single window clearance. They'll give you a piece of land where you will have, the land will be flattened, you will have access to the road, you will have power, you will have electricity. You have to submit your business plan. And if you don't hear from them back in 30 days, you consider your plan approved. So you don't need a piece of paper, you need an acknowledgement that you've submitted that application. So that is the level of pendulum which our competing countries have moved. So there is a desire to move, but the world is moving much faster. And some of the points which he mentioned, I think we have to move much faster in that direction. But we are on the track of deregulation.
Thanks. DK, your thoughts on deregulation?
Well, I think it's in a way a reform. I mean, I would call it. It's a different name for reform. There has been. It's not that it's not being attempted. I mean, we know about the 4 codes, labor codes, which were designed. I think it started several years back. I think it's still in the making. So I think now that is also deregulation in some sense, because you are simplifying, you are getting rid of the bottlenecks. So I think this kind of thing is, I would believe, is easier to identify in the system, I think, and this should be pushed. I mean, which is decriminalization is also in some way, I mean, making it easier. So I look at it from that angle, that I think what the budget was trying to say. But on the point of, I think what Lavish was raising, an important point about the regulatory capacity. And here I think if you want to draw lessons from the West, there is a fair degree of circulation between academics, industry, and regulators. I think they move effortlessly in this. And here I think it's less. I think we should encourage more of that, I mean, I would say.
Okay. Sandeep.
I think my exposure is very limited to one regulator, but I think I clearly see a lot of things are changing for positive. I think the regulator and the regulated work very closely, and I think clearly we also have an intermediate in between, a layer of AMFI, which works very closely with SEBI. So I would say, I think it's many times we expect too much from the regulator, but the regulated have to also go up the ladder and have to come to a point where there's a lot of mutual trust. And I would say, from a SEBI point of view, the industry and SEBI work very closely.
I'd like to just
Yes,
add,
sure.
If you don't mind, I'd like to add. I'm just keeping RBI aside. I mean, I'm not going to talk about that, and obviously, I mean, it's actually one of the most sophisticated regulators. But I'm just going to keep that aside. There are a multitude of regulators. Just classic one is the environment regulators across states and center, right? You also have the power regulators, states and center. Take it seriously. It's a big problem. These entities are not capable of doing anything, and your huge laws are dependent on them. And you're not, and no one really, I mean, I shouldn't say no one, but many people don't have any faith in them. Regulators need a lot of respect for them to be able to do their job properly. So we have to invest in our regulators in order to be able to deregulate.
Absolutely. We have to invest in regulators in order to deregulate. With that, we come to the end of this session. We've run out of time. Thank you so much, everyone. It was really great having you here. Thank you. Thank you so much.